Good morning. We are live. I'm Connor O'Brien, CFO Shares ETFs, and with us this morning we have Selwyn Gerber. Selwyn, how are you?
Good morning, good afternoon, good evening. We have visitors from around the world, so thrilled to be here and to be on this incredible video with live stream with two of our heroes. I think Kevin, that we think the world of you, and Connor, you're great. And of course, I'm the only guy who doesn't have an O in my name over here. It's Kevin O'Connor, and the O shares and O gig and so on. So I think I'll Selwyn O Gerber for today, if you don't mind. And with that, I'll hand over to Connor, and we'll get back to me a little later on.
All right, great. Thank you very much. Today we have an interesting lineup. We'll talk a little bit about the world and markets, but I think, Kevin, what people would really love to hear about is some of the stories from Shark Tank that became real companies that you invested in, and you've been a coach and a source of guidance to the CEOs of those companies through their successes. And I love these stories. Every time I hear them, there's something new that I learn. They're really, really inspirational. So we'll talk a bit about that, and then we'll go back to talking about a little bit of investing, and then Selwyn will kick in with some questions that he's decided might be useful for the audience to hear. So once again, thanks everybody for joining us. Election is over. 2020 is almost over for the markets. I think the stock markets, investment markets are really looking at 2021. And people are making adjustments to portfolios now, thinking of how things might be in the future. We saw great news on Monday at a Pfizer vaccine announcement of 90% efficacy, which is very, very strong. Market did very well on that news. Of course, there's a lot more to follow, and many other companies bringing vaccine and good news forward, though it's still many months before it's actually done, but definitely great progress. And for those that are investors on the call, staying invested is one of the things we always talk about, and adjusting how you're invested is something that Selwyn and his team will take care of. We firmly believe that you ride through these bumps in the market because history shows that the market always returns to new higher levels, and it's very, very tricky to guess everything right, very, very expensive to guess wrong. So staying invested is something we firmly believe in. Kevin, why don't you just touch a little bit on your family trust and this theme of staying invested? What are your views on timing the market, getting in, getting out, versus keeping the family wealth fully invested?
Yeah, our trusts are very, very long-term instruments, obviously, but their mandate is to distribute 6% a year to support the various family initiatives and charities, et cetera, that they support. And year in, year out, that may sound easy, but it's not, because markets have volatility to them over the decades. But the challenge today is, and today was a great year to make this point. Most investors learn the hard way that timing the market is impossible. In 2020, if you were not invested in 19 days of this year, you missed 80% of the returns. We have had such incredible volatility in sectors and in indexes where you had 1,000-point up days, 1,000-point down days, 800 points in 16 minutes, that kind of thing. And that is the nature of volatility when you have extraordinary circumstances like a pandemic, et cetera. But I remember in March of this year, when I was in Miami during the beginning of the lockdown cycle, that I would, at the end of the market, walk outside, have a glass of Chardonnay on my balcony, and look out at the beach. I'd be down millions and millions of dollars, millions, breathtaking losses. And the next day, when I went out with my Chardonnay at 4 o'clock, I was up millions and millions of dollars. And had I tried to time that, I would have lost millions and millions of dollars. And so the point is, I don't care if you have 500 million or you got 50,000. If you're going to be in the market, make your decision about how much is going to be put at risk there and stay the course, because you can't time it. For those who can't stomach that volatility, go to cash for whatever percentage it's going to be, although that has now a zero return after inflation to it. So it's that kind of pendulum that you have to deal with. But it's impossible in a trust structure or even my operating company. I have given up trying to time the market. I don't even attempt to do that anymore. And thank goodness I didn't this year, because, as Selwyn knows, This was extraordinary. Even this week it gave you a sampling of vaccine gets announced. You get 8%, 20% in some sectors in 5 trading minutes. Well, you have to learn to live with that.
If I may just chime in over there, by the way, they say it's not timing the market, it's time in the market. And which is obviously, the old classic visual of, if you want to watch the market long term, imagine a person walking up the stairs with a yo-yo in their hand. The whole trick is to watch the feet and not the yo-yo. Unfortunately, most people are fixated on the yo-yo, which gives you a sore neck, lots of needless anxiety. And the best way to manage volatility really is to ignore the market. I mean, long term, we know we've got 200 years of history. And in fact, I've just got to tell you, we came to this country in 1977. The Dow Jones, when we arrived here, was 850. Just imagine that. And that growth does not include between what you've got to, Connor, what's the Dow Jones right now? Can you tell us easily?
I don't have it right in front of me now.
Well, make a guess. What do you think it is right now?
Where are we at? I don't know. Let's call it closer to 30,000.
Okay, so from 850 to 30,000, you didn't do a thing except restrain your impulses and your instincts. It's all you had to do. Just restrain yourself. The big, Warren Buffett says the investor's chief enemy is himself. And so I would just say to you, we totally agree with you. And part of it is, if I could just elucidate on one of the points you made, people confuse risk and volatility. We view them very differently. And I know the MBAs from the great universities and the Wall Street geniuses think of them as the same, but we really don't. We view volatility as simply a manic depressive appraisal system that periodically overvalues and undervalues assets in response to the passions of greed and fear. And risk we view as the possibility of permanently losing capital. And I will tell you that any of your fund, any of the O-share ETFs, really, and all of the things we do really replace risk with volatility. And volatility is your friend, provided you can ignore it. Sorry.
That's actually great advice. Selwyn, I'm going to steal that from you. That is fantastic television. That makes total sense, because your primary mandate as an advisor, and I'm just an investor, is to preserve my capital. That's all I care about. I know it's going to be worth more or less every day, but I just never want a zero. A zero I can't recover from. Everything else I can deal with. That's very good advice.
It's yours.
And without volatility, you probably have no wealth creation. If you have a zero volatility investment, it's probably a zero return investment.
Look, here's the real thing. Volatility is the price that investors pay for the extraordinary returns they've earned over the long term. It's the admission fee.
I agree with everything you're saying. These are extremely wise words you could only have having lived through the markets, because you're right. I get lots of advice from particularly some of my own staff that have never experienced the volatility that they're seeing now. They have never seen this before. They have a lot of questions, and I keep telling them, they keep thinking if I just sell at the right time and buy at the right time, I could jack up my returns by 10 times. It's impossible to do that. And they learn the hard way. And the other thing I would say that we didn't mention is I don't like using leverage in my portfolios. I've learned in doing that, you particularly in fixed income portfolios, if you have a mandate that's making 3% with triple B bonds and you put 100% leverage on it, you can make 6% until you have a crash in the market, and then you're forced, because of that leverage, to take losses, which I don't like. So, that's another 2 cents.
Sorry for the distraction.
No, but it's very good. I agree with it.
You got lots of
great on target.
Yeah, thank you.
And a good reminder for your clients of how you think of managing their wealth. So the people that are on the call here, some of them have made their wealth and they're enjoying it, and some of them have kids and family members that are younger, earlier in their career. And Kevin, I know where you're going to go with this, but what would you share as your guidance to these young people that are early stage of their career? Maybe they're not even into their career yet. They're in college. What would be your guidance to them if they want to be an entrepreneur, and if they otherwise want just a solid career without the risk and challenge of being an entrepreneur? 2 types of people. What are the 2 types of advice?
Yeah, and I deal with that in my own family, obviously, and I spend a fair amount of my time guest lecturing now, primarily to graduating cohorts of engineers because a third of those classes at MIT, Harvard, Notre Dame, Temple, McGill, Waterloo, those are some of the centers I do this work at. They're going to start companies, and I love to see their ideas early. You know, I always tell them that entrepreneurship is not a destination, it's a journey, it's a lifestyle. It does throw your life out of balance for quite a while. Most people think it's get rich overnight, but most entrepreneurial journeys are decades long to success. And so there's no soccer games on the weekends with the kids, and you know that you're going to be under tremendous stress when you're building your company, because unfortunately what's happened over the last, I'd say this is a 15-year phenomenon, you're not competing with somebody in Dallas, Texas, you're competing with somebody in Shanghai or Mumbai. And everybody is going to kick your butt if you're not ready to compete. And those guys don't go to bed at 7 at night. They work 25 hours a day. There's men and women around the world that are very, very competitive. And I tell, you know, my young entrepreneurs, get ready for a hell of a ride, because it's not going to be easy. That's a third of the population is willing to do that. The other 2/3 should be happy to find careers and work for corporations and be great employees, because you can have a great life there too. A much more balanced one, a much more interesting one. But for families that are dealing with transfer of wealth, and I have, you know, I deal with this myself in my own family, is I would not entitle children. I have lots of friends with really messed up kids that they've entitled. They've de-risked their lives. My mother used to say, when she cut me off after college, the dead bird under the nest never learned how to fly. And so she stopped. She paid for my education for the last day of college, and then she gave me nothing. And I nearly went personally bankrupt. And she said, you know, that's how it works. You're not getting anything. And she actually, when she passed away, she was a very wealthy woman, because she was taking money out of her salary. She was a working girl, but she invested for 60 years in S&P stocks and telco bonds and died very wealthy. Just by staying the course during that whole period, by taking 20% of her salary. And I was wondering how she did that. But I copied her trust structure. My children get full freight from birth to last day of college, and then they get nothing. And when my son was in grade 11 in Boston, and he came to me, it's really bad marks. I mean, he said, "Can you walk me through the trust again?" I said, "Yeah, Trevor. You know, if mom and I get killed going out tonight by a bus, you know, going out for dinner, you don't have to worry, because the trust is going to pay till you finish high school, because it doesn't look like you have to worry about going to college. Your marks are terrible." And then he said, "Well, what happens after that?" I said, "Nothing. You get 0. Now, when he saw the darkness of his situation, and you know, this may sound draconian, but he really had a wake-up call. He went, "Yikes, you know, that's not good." I said, "No, it isn't, but that's just the way the trust is. My mother did it to me, and I'm doing it to you. You have a long runway here. I pay the full freight." So he took me on a ride right through engineering. I paid the full pop. He's just going to graduate this month, and he's on his way to work full-time at Tesla. I congratulate him. It's fantastic. He did it on his own. I paid the full pop, but when he goes to work, he's on his own. And I told him, "Don't ask me for an investment if you're doing a startup. I'm going to want a royalty."
Let's go to startups. Everybody knows he's from Shark Tank. I think almost everybody loves Shark Tank. And you've seen so many entrepreneurs and successes. And I got a few companies I want to ask you about. I love every one of these companies. But the one I'd love to start with is the Cupcake Company. It sounded so crazy. You buy a cupcake in a jar and ship it across the country. Mother, daughter, they create this thing called Wicked Good Cupcakes. And everybody would all the other sharks stepped back, and you stepped up. What did you see in those two women that caused you to make that investment in what sensible people would say makes no sense?
Yeah, they came on the show looking to get an investment in a commercial kitchen, because their volumes were increasing, but it's a total commodity. It's sugar, water, flour, put in a jar and shipped to people. What I was learning at the time, this was in season 4 of Shark Tank, as it was starting to grow geometrically, millions more people each week watching it, that in America, the number one reason companies go out of business, 8 out of 10 fail within 36 months, is they're never able to get their customer acquisition costs below the lifetime value, a fancy way of saying they go bankrupt advertising. So they pay more to acquire a customer. But I was starting to watch companies that would get on Shark Tank. All of a sudden, they go on the air, like this Friday's show, and we would sell $5 million worth of their products in 1 hour because 10 million people would see it. And so the customer acquisition cost there is zero. And I was thinking nobody would touch this cupcake company. And it was the first time ever that it was a pure royalty deal, first royalty deal in Shark Tank history. I said, look, I think equity in a cupcake company is worthless. I think cash flow, present value of your long-term cash flow is worth something if I can help you increase it. So I'll invest in you, and if you give me $1 a jar for every cupcake you sell. And she came back to me and said, well, I'll give you $1 a jar till you get your money back, and then it's 50 cents a jar. And I said, okay. Well, I made my money back in like 4 hours because it aired, and it just sold millions and millions and millions of cupcakes. But it took me months to ship it because we were so inundated. But that was the first time that we realized the power of television. And so that was the beginning of the whole royalty structure. Many of my deals are like that now. Shark Tank's very, very powerful in selling product. It's the best commercial you can have. It's 8 minutes of primetime television, and then in syndication in 34 countries in perpetuity. What's that worth? It's worth a fortune.
That's huge. And this mother-daughter have gone on to innovate other ways to keep their story fresh and keep their sales volumes growing without Shark Tank. Now they're on their own doing some things. Just tell a little bit about that, because I think it gives people some sense of how that creative initiative can take a very, very straightforward business and turn it into something exciting.
Yeah, the daughter, if I don't know if people recall the episode, she was covered in tattoos. And that was the first time, that was a trend that was emerging back then. It was 6-7 years ago, and very young person. And she's actually a wealthy woman today. She was getting married to a drummer, and I helped with her prenup. That guy gets nothing. But it's just that's the way it is, and they've gone on. They've moved to warmer climates now. It's an American success story. They have 26 family members running that business. They have commercial kitchens all over America. They're the #1 cupcake FedEx. The pandemic blew up their business by another 400% increase. They do vegan, they do plant-based, they do low carb, they do all that stuff. There's professional managers running it, but it's a classic American family business, and I have no right to have equity in it, but I'm still getting a royalty. And even my accountant thinks they're selling something else, not cupcakes. He just can't believe it. It's just been every month. It's just a wonderful story for everybody involved.
That's a fantastic one. There's another one that I know you like to talk about. I love to see the artwork that they've come up with. It's called LovePop cards, and it's fantastic artwork turned into a greeting card, which is a business that basically had faded. Then they maybe revived the whole sector. Just tell us a little bit of the story there. Who are the entrepreneurs? Why did you step up for that one?
Yeah, that's an extraordinary story. In fact, I'm holding one in my hand because I knew you were going to bring it up. The story is they were two naval designers, architect designers for warcraft, for very sophisticated black operations, marine boats, stuff that the Navy has that you don't even know about. These guys made that stuff. And they were Harvard, MIT grads, two of them. And here they come on Shark Tank, and they talk about making greeting cards. You can't make this stuff up. I said, you have given up that career to make birthday cards? They said, yes. We have come up with a business, and I'll show you what it is. This is a LovePop greeting card. This is a 3-dimensional laser cut in Vietnam, giant football field full of Hewlett-Packard lasers, very complex designs. As you know, the greeting card business is very emotional. The purchase is done at retail, birthdays, holidays, special moments in people's lives. This company even had a store in Hudson Yards. The most expensive real estate on earth for retail is Hudson Yards in New York. You can't pay more per square foot. When the pandemic hit, like many companies, all their retail business went to zero. And the company was in dire straits, as you can imagine. And here's the big digital pivot. So I have another example here to show you. I love this story because it shows American ingenuity. Here's another card. This is one of the most popular. That is a dragonfly. The complexity of those wings is extraordinary. People get these cards, they never throw them out. They're like art. So business goes to zero, end of March. It's Mother's Day coming up. One of the CAD designers, a woman in Boston, tried to buy flowers for her mother. As you know, all the distribution for South American orchids and flowers and roses cut off. The flowers rotted in distributors all across America. No flowers for Mother's Day. So she sat down at her CAD desk and designed this. Ready for that? That is a bouquet of roses, three-dimensional. It's not a greeting card at all. It's a bunch of roses. They went online. They offered this. It exploded in upside. $29.95 for roses they could ship to your mother. It was incredible recovery. The business exploded to the upside. They're now ahead of forecast. They've gone to a direct-to-consumer business model. The great digital pivot. They used Shopify, DocuSign, Wix.com, Zoom, CrowdStrike, all of these technologies to digitize their business. And what they lost in retail, they covered direct. And that is why the market is so buoyant for many S&P companies now, because Nike, for example, did the same thing. When all the stores closed down, they accelerated their direct-to-consumer sales globally from a fraction of the total sales to 33 to 30% in 5 months. What they forecast was going to take 5 years, they did in 5 months. And when you sell direct-to-consumer, that's 100% gross margin versus 50% in retail. Same with LovePop. So that's why I'm extremely optimistic about the economy and the enhanced gross margins. And I would add that, an index that I had a hand in designing, you well know this, Connor, OGIG, is full of those companies. It's up over 70% year to date. But it's the companies I'm buying licenses from. The DocuSigns, the JD.com, the Wix.com, the CrowdStrikes, all of those companies are the Microsofts. They're the companies that I buy licenses from for across my private portfolio. So why wouldn't I want to own them? And I do in OGIG. So that's sort of a story of success, American entrepreneurship, but also the power of the digital pivot that's occurring across America now, which is why the markets continue to be buoyant. It senses that post-pandemic, we're going to have a better, more efficient economy.
And you've got an equity ownership and interest in 50 plus companies. I'm going to ask you about the overall story in a second, but one more company that's fantastic, and I know a lot of the audience on this call is likely in the California area where this is going to, I think, resonate with them. Blueland Cleaning Products. Everybody who goes to the supermarket and gets all of their stuff, including cleaning products, brings home bottles full of water with a little bit of the cleaning, it's called chemicals in there.
Yeah.
And these kids created something that's a phenomenal transformation of how people are going to be buying those cleaning products. It's an amazing story. Tell us, why is that you stepped up and won essentially that opportunity to invest with those entrepreneurs? Why did nobody see what you saw? One of the themes, and you're seeing it in this season of Shark Tank, but it started 2 years ago, is this concept of sustainability. I always thought in the early years that people used it as a marketing tool to talk about sustainability and saving the planet. That's not a marketing tool anymore. A vast majority of consumers, particularly millennials and young parents, have this in their own mandate of purchase. They want to know that when they buy a product or service, that it somehow is sustainable and it's not destroying the planet. And that's certainly going on in one-use and single-use plastics. And one of the largest use of single-use plastics is detergents and cleaning fluids. When you go buy dish detergent in a plastic bottle and you throw it out, you're one of the people throwing out 5 billion plastic bottles that end up floating around in the ocean, or slowly disintegrating into plastic molecules in the earth. And that is not a marketing story anymore. That is a concern that people have. So what Blueland said is, I'm showing you this little tablet is crystallized cleaning fluid. It is a new technology developed by a Pakistani engineer that was working for a giant American citizen working for a giant consumer goods company, designed this and left the company and formed and was one of the partners in Blueland. And they came on Shark Tank and said, instead of buying dish soap, you get this little tablet and you throw it into a reusable bottle that you never throw out, and you have high quality dish detergent
with no, no detriment to the economy. And they had every big box retailer in America was signing up with these people to launch. And guess what? The launch was going to be on the 15th of March, 2020. and I mean, you couldn't have foreseen what was going to happen. And so what happened was we did a digital pivot and we started buying remnant cable ads. The company went from no sales to $3 million a month in a matter of weeks. It's one of the greatest success stories in Shark Tank history and continues to grow. And they're crystallizing every kind of cleaning fluid. And yes, I just thought she was an amazing entrepreneur. So many of the companies that made money and are run by women, they mitigate risk so much better than men do sometimes. But she was phenomenal, and I'm a shareholder, and again, a royalty deal and shares. I went both ways on that one, but it was great success. And it's not about retail. It's about the digital pivot, and every American company, including the S&P 500, is doing the same thing.
There's one more that's actually, let's call it the chemicals replacement category, the insect repellent company. Insect repellents, as a lot of people know, is highly toxic chemical stuff.
Well, yes, that's called First Saturday Lime. That's a farming family in Kansas, and they're doing very, very well. Actually, Oklahoma, I'm sorry. They have the best lime in the world on their family land, and we add citric acid to it. And we ship it in 10 pound, 5 pound, 20 pound bags. You simply sprinkle it around your home, way better than any pesticide. You can even sprinkle it on your dog. You can eat it. It won't harm you. And yet it drives insects crazy. It's just a chemical combination. And one other I wanted to show you that I just got numbers on today. I can't believe this business, what it's done. I was never going to invest in it because I thought it was a joke, but it's one of my biggest successes. Base pause cat DNA test. Who could have guessed this would work? 110 million cats sitting at home with their owners looking at them in lockdown, wondering how they can help them be healthier for their 21 years some cats last for. Well, Base Pause does it. Who knew? This company, I mean, I thought it was a total joke. I was wrong. That's why you got to take a portfolio approach to investing in companies like this. This is crazy. This is cat DNA tests. Who does this? Well, millions of people, it turns out. Nuts, completely nuts.
That's unbelievable. So you've got an investment in 50 plus companies. How do you manage all of that? And what interaction do you have with the CEOs of all of these companies?
Well, it's hard to manage that. No venture capital firm has that many positions. We do it by simply asking for tear sheets, which are only 2 numbers. We want top line revenue per week, and we want free cash flow per week. We don't care about anything else. I can tell you what's going right and wrong with the company with just those 2 numbers each week. I've been doing this for decades. Cash flow is all that matters in a private company. And you can tell a lot just between the difference of the top and the bottom. You can determine what's going on in gross margin. You can see all kinds of things happening, good and bad. That's how we manage it. And generally speaking, we're looking for that slow growth in the top line. And we think a properly managed private company makes 15% pre-tax. So, from an EBITDA basis, we can really monitor the health of those, just like you would with an Apple Watch on your wrist. We're looking at all the pulses of all these companies. And I would say after the pandemic that 80% of them are going to get through. And the ones that aren't going to are involved in the cruise line industry, the airline industry, the hotel industry, the food services, restaurant industries. They probably aren't going to make it, but those entrepreneurs are great and they will find other things to do. But 80% success rate's pretty good. And that reflects what's going on in the economy. People's preferences have changed as a result. If you couldn't get me to buy debt or equity in a theater chain, I think in 10 years, they'll all be gone. People are used to seeing their tentpole movies on their own home screens and devices, and I think they'll all go to zero. I think the airline industry is in for a shock next year, even after the vaccine, because I figured out I can cut my travel costs by 20% in my companies, and we're going to do that. If I own the company, I have control, and you want to fly somewhere, you have to write me an essay and give me a forecast of the return on my $4,000 investment to fly you to a conference. I want to know, do I get 11% return on that? And I know the answer is no, so you're not going. And so you can do it virtually. So there's lots and lots and lots of changes that are going to be going on in the economy.
I think that's absolutely right. Just thinking about the challenges, let's call it outlook for the next 3 years, 5 years, 10 years. As an investor, as a society, what does your information flow tell you about the outlook, first for investors and people's wealth? What should they be concerned about or not so concerned about?
Well, I mean, I've made some sectoral adjustments in my own portfolios. I used to be over 30% involved in real estate. I've reduced that down to 8%. And the cash that generated, that was how I funded some of the OGIG purchases I made, the OUSAs, the OUSMs, but also extended into healthcare. I'm a big believer in the healthcare sector over the next 3 to 4 years, because we're going to be repatriating most of the supply chains for hazmat, medical supplies, generic drugs. It'll all go to, Puerto Rico, Mexico, Canada, the United States. There won't be much reliance on China or Asian supplies for important medical. We have, I don't like to think this is good, but we have COVID-20 and 21 to look forward to, and we have to have a much better response to those whenever they come. And that's going to be a big focus of, trillions of dollars into healthcare. And I think every investor should think that through. So, I'm not so optimistic about 75-story AAA office towers, because I know I'm not using them as much anymore. And I certainly don't want to be on the 70th floor where I have to sit in an elevator with somebody for, 4 or 5 minutes jammed in with 60 people. That psyche is going to stay in people's heads regarding the flu season, COVID-20, whatever else is going to ail people. There's going to be a slight change in people's propensity to be in jammed close quarters. That's my take. Others may have different views, but I'm certainly investing that way.
Well, I think everyone's going to be looking forward to vaccines and a bit of a return to normal. I also think many people prefer working from anywhere. You came up with that expression earlier, and it's not just work from home, it is work from anywhere. Why rent expensive office building when you can make other choices? Let's get to a lighter topic here. In the past few months, I know you're big on wine. I am nowhere near the wine connoisseur that you and your wife are, but I've tried some organic wines, and they have less sulfites and less chemicals and less of that crap, less headache in the bottle. Great flavor for 20 odd bucks. Just tell people what you've learned by getting into the wine business. What is it about wine that makes it a business or not?
Yeah, I've always been, I have certain passions. Winemaking is one of them. My wife is almost a sommelier. She has a very good palate for New World whites. She mixes and blends an amazing unoaked Chardonnay that we've sold, hundreds and hundreds of thousands of cases of. I'd like to think of myself at blending Pinots, Cabernet Sauvignons, Syrahs. So we have a pretty interesting wine business. Now, I was losing money in the wine business for 5 years, as most people do, because what I learned, and again from Shark Tank, actually, I met Annette Alvarez when she was the head buyer for Costco. She was the largest buyer of wine in the world, all pensions, all the French, all the Italian. She was number one. Costco is an amazing distribution system, but she told me that the majority, 97% of wine sold in America, is sold for under $15.99 a bottle. 97%. And if I was ever going to make money, I would have to learn how to make great wine and sell it, for under $15. And I couldn't figure out how to do that for the first 5 years until I met Annette. And then she said, it's all about volume. If you become a big enough buyer, if you can break 100,000 cases in a year, then you can be a major player in the wine business. Because most of the guys that lose money are, they're doing 5,000 cases or 6,000 cases, and they try and price the wine at $250 a bottle, and it's just a miserable outcome. Then then the laws changed 4 years ago, where you could ship to 42 states direct from the winery. So I could cut out 3 tiers of distribution. And so I got a contact from QVC. They have 6 million people that watch QVC and buy wine in those 42 states. And we formed a partnership. We basically went into business together. They bought all the supply I have. And I go on like I am now. I'm going to be doing that actually on noon with David Venable this Sunday. Dave and I have a huge wine sale, and I will sell millions of dollars of wine in 11 minutes. And I will ship it direct to these customers. I'll be shooting it from my granite wine cellar, and I am bringing to market 4 award winners. I've been very fortunate. My wines have been winning awards all over the world. My Syrah is won 8 awards, and I'm bringing that to market on Sunday. I'm going to sell out of that, I think. I don't want to blow my own horn, but I'm selling that bottle for $11.33 a bottle, and I'm going to sell every bottle I have. But my point is, the world's changed. The digital pivot allows me to connect directly with my customer and the QVC base, and we will sell together 100,000 cases of wine. And now it's profitable. And I'm very proud of the fact that Annette Alvarez was, you can find these mentors. She taught me how to do that. She said, Kevin, if you can't sell 100,000 cases, you're going to be a miserable wine guy. You're going to lose lots of money, and you're going to keep telling your wife how smart you are. And she's going to say, hey, bozo, stop wasting all that money in your vanity project. Now I make money in the wine business, so I'm not such a bozo anymore.
Some interesting takeaways from that for sure.
Yeah.
Selling.
Can I just chime in with something? Because first of all, I think that our fondness for your company, for you, for the OShares group really grew out of our investment in OGIG, which has been remarkable for our clients. Almost all of our clients have OGIG in their portfolios, and I think it speaks for itself. One of the companies I'd like you just actually to do an in-depth look at OGIG in terms of how it's constructed, why you went into it, and particularly, if you can, do a deep dive into Shopify. And
yes,
so attractive. Yes. I find that to be an absolutely fascinating example of the digital pivot.
Well, Selwyn, Connor is the CEO of OShares, and he deals with the remarkable complexity of building these indexes, and we own them. But a few years ago, I called him up and said, hey, Connor, listen, you got to see the amount of checks I'm writing to these guys at Shopify. And here's why I'm writing the checks. If you look at a typical American private company, it's 50% before the pandemic was sold in retail. The Walmarts, the Targets, the Bed Bath & Beyonds, and all these companies that I was doing business with. That was 50%. But Selwyn, 40% was Amazon. They had become the largest retailer we deal with. And I made 50 cents on the dollar with Bed Bath & Beyond, let's say, or Walmart or anybody else, but I made 60 cents on the dollar with Amazon, with the one problem that they would never give me my name of my customer, because they would ship my competitor's product in the same box. When you order something from Amazon, it comes with the Amazon brand on it, and you don't know what's in the box, your product along with everything else. And so I started thinking to myself, as we were dealing with my CEOs, how do we get our customer back? Amazon won't give it to us. Well, I'll tell you who gave it back to us. Shopify. They said, not only can you have Amazon-like margins, but we don't steal your customer's name. It's yours. So as soon as I realized that, we started digitizing, and it wasn't just Shopify. We went to Facebook. We started using their geo-locked advertising. We did Instagram. We did Wix.com for the better, richer online experience to help support our Shopify platforms. And as I was writing all these checks, and I'm talking millions of dollars, I'm calling up Connor saying, Connor, these guys are growing like a weed, and I'm just one person buying their services. Why don't you index the global internet giants? And he'd already had the idea. And that's when he created OGIG. And I was the first investor in that because I was the biggest spender on all those things. Every single one of those names is the ones that are digitizing the global economy. And so, it's a, and when I was showing it to my son, Trevor, the engineer, he said, yeah, these are the companies I want to own. And I said to him, Trevor, you got to own a portfolio of companies, because he's now investing. He started to put aside his own dollars. But OGIG reflects the digitization of the global commerce. And that's what's in it. And Shopify they now have 1 million businesses on their platform. All of mine, plus, millions more that are going on there, because now we can control our own destiny. So it just reflected what was happening in my own world with my own companies. And of course, I'm a big shareholder in it. And I think we're only in the third inning. I mean, my dad, I know I shouldn't talk my own, my own family understands what's going on here. I build these indices for my own family, and we eat our own cooking, just like my wine business. So it's sort of, I'm very happy, and I'm very happy with the performance, and I'm going to stay long for years because I can't tell you how much I've just spent on Shopify this month. They're fantastic.
That's an example of one of the 60 plus stocks in the OGIG portfolio. And another way to answer the question, Selwyn, is old technology versus new technology. Old technology companies are all these big companies with great names and a great history and relatively low growth rates for the future. And they're names like Cisco and Intel and IBM and so on. And we all, one way or another, depend on some of their products. However, the technology index, the way it's defined by the companies that do these definitions, the generic index, as we call it, does not include the companies Kevin just talked about, does not include Amazon, Facebook, Google, Shopify, and so many other very fast growing e-commerce internet services type companies. So we created OGIG to be the answer to this question. Where are the new technology companies? They're not in the traditional generic technology index funds. And we did the work to research how one can identify using financial metrics the successful companies. And it turns out to sound like motherhood and apple pie or common sense, but we're the only ones who actually created the common sense approach to this. Strong revenue growth, profitability, great balance sheets. They have a shot at being in the portfolio. And then those that, of course, have the best measures on those quality scores, growth scores, are the ones that end up in there. Gets adjusted in a way that's got no passion to it at all, except that we believe in it. It's not whether Kevin likes the company or I like the company. Does the company actually measure up to those financial rules of strong revenue growth, profitability, great balance sheet? If yes, gets in. If no, it's out. And it's been a phenomenal performer, and the revenue growth of all those companies is what we expect will continue to drive the performance of the companies and of the fund.
If I can just chime in over there, one of the reasons we liked OGIG as a core holding for almost all of our portfolios is not only because of what you own now, but we were very impressed with the dynamic rules-based approach, so that, as you've alluded to, no one's sitting there saying, well, what do we think of Shopify? I don't think anyone there is thinking about Shopify, because you're looking at numbers, you're looking at data. And the reason I'm pushing this point is because OGIG isn't our only holding. We have a number of ETFs in our portfolios, but they all have this attribute of being a rules-based, disciplined selection process that adjusts dynamically to the changing environment. I assume that if Zoom shrinks its volume enough, at some point it will be automatically kicked out of your portfolio because it doesn't meet the objective criteria. And so that approach, which is a ruthless, bottom line oriented selection process, without any loyalties or alliances or allegiances to anything other than a set of rules, creates what we call a Darwinian selection process. They're either at the top of the pile or they're not there. And that thinking is very attractive to us and our clients. After all, we're not golf players, and I don't mean to offend my friends who are golf players. That's not our specialty. We're a bunch of number crunchers. We're CPAs and CFAs. We look at the numbers, and your approach aligns completely with our basic approach to equity investing. So thank you.
We like the way you summarized it. It is Darwinian, and it's the same Darwinian approach that applies to, or that description applies to OUSA, for example. Large cap stocks are not all the same. Some of them have better financial metrics than others. And if you look at the performance history, and we've done the research, of course, of the ones that have better profitability, better balance sheets, growing their dividends, they have outperformed the ones that have lower profitability, weaker balance sheets, and less dividend or no dividend growth. And so those are the characteristics of OUSA. OGIG may be high growth, and yes, with it comes some volatility. People may want to counterbalance. It's amazing what happens, when the COVID numbers get worse, the OGIG type stocks have performed extremely well. When Pfizer announces what they did on Monday, the vaccine, a bunch of, let's call it, more traditional stocks tend to do better. And it's an interesting counterbalance to have a bit of both, so that you own the highest quality stocks of both categories.
See, I think the key theme that that we believe, practice, and embrace from you guys is the days of picking individual stocks are gone, because there's no, in this dynamic environment, I would challenge anybody to pick a company and say, well, I'm absolutely certain that'll be around 10 years from now. Because for every company you give me that you're certain will be around 10 years from now, I'll give you one that looked equally certain to be around 10 years ago. And so in a dynamic environment, you need a dynamic selection process to make sure that you have the opportunity to make these exchanges. And the ETF structure, and I'm speaking now as a CPA and tax guy, the ETF structure is a gift to wealth managers because it enables you to make these changes without a tax cost. Now, that's not something you can do on your own. So if you want to get out of Microsoft and move into a Shopify, for example, and you've been holding Microsoft for a while, you're stuck. You're stuck, even though that may not be what you would choose today. Whereas the unconstrained environment of an ETF system allows you to make those changes without any current income tax impact. So you're freed to make the best decisions without having the tax tail wag the dog. And that's something that, you know, we love about the ETF structure, which you obviously are adherents to.
We absolutely agree with you, and the tax advantages are extremely important, because compounding the value of your investments without having to pay the tax man is a lot better than having to pay the tax man some of your returns that, once you've paid that money to the tax man, will never compound in your portfolio. That money's gone. It's a little bit like a fee, and the tax man is the worst person to give that money to, perhaps. So we're close to running out on time here. I'm going to ask one kind of fun question of Kevin and Selwyn. If you have another one to follow, I'll let you do that and let you handle the wrap up. Kevin, everybody on this call knows Shark Tank. Shark Tank's had an amazing run, and people are going to be watching Shark Tank for the next 12 months and maybe the next 12 years. What are some of the highlights to expect that are going to come up in this season that has been recently shot in Las Vegas? What can we expect to see?
Yeah, I mean, Friday's, tomorrow's episode, for example, is a good cross, mix of the kind of companies that emerged during the pandemic. Because, American entrepreneurs have been sitting in their basements for 7 months, and you're going to see a lot of that reflected in just tomorrow night's episode. I mean, I think what's great about Shark Tank now is it's an iconic platform. It's known by most Americans. People know what it is. They know that if they're an entrepreneur, it's a huge benefit to get on Shark Tank, because it gives you a chance to get your product in front of 10 million eyeballs and gives you free customers. And so we get a huge portfolio, including venture capital companies now that want the same benefits that just a basement startup has. And so as a result, this year, you're going to see some very high valuations, $50, $60 million valuations. And because those companies have sales and they want the Shark Tank factor on top of that. So it's really interesting. The sustainability theme is there. By now, most people know the sharks personally in terms of their portfolios, and they try and pick a combination of one or two sharks they want to be investors in their company, because if it's in the wedding industry, for example, or the wine business, they're going to come to me, or financial services. Anybody doing fintech, I usually see those deals first. But that kind of thing is just the result of the platform getting so big. But it is now the #1 show on Friday nights on any network, and it has a very, very wide demographic. 90-year-olds to 9-year-olds watch it. It's one of the only shows you can watch with your family, and I think everybody learns, including the sharks, each year. So I'm very proud to be part of it, and obviously, we're making plans to shoot season 13. We don't yet know if it'll be in the bubble or if it's going to be back in the Sony lot in Los Angeles. Who knows? I mean, it depends on how fast we can vaccinate the sharks and all the contestants. So stay tuned. We're like any other American waiting to see what happens.
Yeah, it's a huge success. Thanks for the update on it. Selwyn.
Yeah, hi.
Would you like to find a question at Kevin? A couple of questions.
Yeah. Well, I got one kind of two-part question, but I'll give it to you. So Kevin, just stepping back, how do you see the U.S. economy going forward in general? Not just the technology, but if you look at the economy as a whole, post, with pandemic looking like it's probably coming to the end. At least it's visible, it's foreseeable, it's plannable. They're talking about vaccines and so on. So it's no longer, a dark tunnel with no light at the end. I think the light is there, and I don't think it's an oncoming train this time. And so I think we're coming to the end. So in a post-pandemic Biden presidency situation, how do you see the U.S. versus, first of all, U.S. doing generally, and then, the U.S.-China issues and international trade? Can you give us a kind of a macro view, please?
Sure. So let's take the policy environment. I think it's highly likely that the Senate stays in Republican hands, so you've got a real good check and balance. You're not going to see the extreme socialist trends that were a concern to many investors coming with a Biden mandate, which he now has. So I think it'll be very balanced. I think we'll stay the course. I don't think you'll see any dramatic tax increases, corporate or personal, because you can do a lot of things with executive orders, but you can't increase corporate taxes. So, and I think his number one mandate for the next 18 to 24 months is going to be to eradicate this pandemic from the economy, and which is going to be a fair amount of work and focus. So I think we're in good hands there. And so I'm very, very bullish on just the policy. I think we'll stay in a competitive place with China. I don't think Biden will significantly change that either. And yet we'll probably have more harmonious relationships with the Europeans. I'm not sure that's a bad thing. But anyway, so that background's great. But for earnings, and this is where I'm extremely bullish, what I think the S&P 500 and many private companies, and certainly the ones I'm involved in, have learned is that we would have never forced ourselves to work remotely. We would have never forced ourselves to close retail locations, but we did. And we figured out now that there's a new digital economy that we can engage in that's far more productive. And to specify, so and what I think that really means to S&P earnings is, I think that companies, just in saving, they're going to have three engines of enhancement. They're going to sell more products direct to customers at higher margins. Number two, they're going to cut corporate overhead costs in office space. Most large corporations have programs that allow between 10 and 15% of their employees to work from anywhere they wish. And you've seen that already put in place with accounting firms and consulting firms and tech firms and Google and everybody else, Box, they've all announced their programs for 2021, 2022 and onward. So you're talking about a reduction of corporate office space of maybe 12, 15%. But the big savings, and the one that's still, I think, just intriguing, is business travel. I think we're going, in my world, we're cutting that by 20% next year, and I think S&P will as well. And so where does that manifest itself? I think you're going to see 1 to 1.5% increase in gross margins, which, by the way, is like a 10% enhancement to the typical public company, to as much as 300 basis points. So, you talk about, is the market overvalued? I don't think so. I think you're going to be pleasantly surprised over the next 36 months in how productive the S&P is going to be using these technologies, having proven them for the last 8 months. And so I'm extremely optimistic in America 2.0 for the next, 3 years, and which is why I'm very focused on owning high quality balance sheets, but a wide range of them, because I think we're going to have really, really strong equity returns in addition to whether it's $1 trillion or $2 trillion being rained onto the consumer by the government in the, post-election support program for unemployed and small business. So I don't know. It's just a pretty good setup. I'm extremely bullish, and I'm staying long the market.
Terrific. If I can just kind of wrap up, first of all, thank you, gentlemen, for your time. We really appreciate it. Friends, clients, associates of ours around the world are watching, and thank you for your great insight, which you should know totally reaffirms our position, not only in the bullishness of the American economy, which we think is affected not only by the things you've said, but also by what's called the fourth industrial revolution, 5G, robotics, artificial intelligence. There's a whole group of things, that are going to transform entire industries. So we share your bullishness entirely. We share your approach to the selection process, which is dynamic and tax efficient. And we're delighted to have this close relationship with you as one of our core relationships. We've had a terrific year at RVW. Just so you know, and you should know, we're coming in on $1 billion under management. We expect to reach that over the next reasonable period, which has been a terrific period for us. Our clients are happy. Our people love working with us. We have a high passion quotient for what we do, which starts with me because I'm very, very high passion about this, as you may be able to discern. And it goes down to everybody. We love what we do, and we love working with people that share our vision. So thank you for being part of us.
Thank you, Selwyn.
Great. Thank you very much.
Bye-bye.
Right there, everybody. Thank you.